All right, welcome to followmetrades.com, my secrets to trading success webinar. I'm Dean Jenkins, founder of followmetrades.com, and I'm excited to present this material to you today. Just before we jump into the material, I just got to show, here's the S&P 500, the SPY ETF. Man, look at that, record high on Friday. The S&P 500 went above 4,000 for the first time. And man, what a run it's been over the last year since, the pandemic hit and the recovery started. Wow, big move up. We do note that the momentum of this up move, even though it is putting in new highs, the momentum is decreasing. This is called bearish divergence. So that's something to keep an eye on there. Each up move and the momentum of it is getting smaller and smaller. And, just having a handful of techniques like that to analyze the market is helpful. All right, so let's go into the material here. So, I titled this webinar, my secrets to success, and the real secret is there's no secrets. That's the one thing. It's just basics and keeping it simple. And we all have a tendency maybe to overcomplicate things and to look for, that one indicator that's going to, be the key to unlock wild profits, right? There's no one indicator. There's no magic feather. There's no secrets, right? The overriding concepts in trading success really are keeping it simple. You got to control risk, and you got to be as objective as you can to, you hear people say, get the emotion out of your trading. We're all going to experience emotion, right? We're going to have fear and greed. And when a trade's winning, we're excited. When it's losing, we're bummed. The key to all that is to, despite whatever emotion we're experiencing, to make our decisions in an objective way, take actions in an objective way, despite emotion. And, that comes from having a trading plan. Here's what is true, right? Consistent, respectable profits are absolutely possible in the market. What's not true is that it's easy or that you're going to get really rich really quick, right? The only way to get really rich really quick is to gamble, to take really large bets on trades. And, if you take a large bet, you might get lucky, but you might lose it all. And, if you're going to bet the farm, you got to be willing to lose the farm. And I'm just not. So we can do well in the market, though. Quick disclaimer, I'm going to show some live charts, some trades that I'm in, some trades that I like. But I'm a trader. I'm not a financial advisor. I'm not giving financial advice. All trading and investing involves risk, and risk control should be used at all times, and I'll explain how I do that. Okay, just to introduce myself, you may not have been at one of my webinars before, may not know who I am. So I'm Dean Jenkins. I'm the founder of followmetrades.com. I've been investing in trading for over 25 years. And I really got started when I was working for Intel Corporation, and they gave us incentive stock options, and we had an employee stock purchase program. And I joined in 1993, and 4 or 5 years after that, that was a really big deal because Intel split and doubled like clockwork. And all of a sudden, those options and the shares we had bought were worth a lot of money. And it was like, hey, this is a cool deal. During that time, I got my MBA from the University of Washington, and I got interested in the market and trading, and I was a fundamental trader, analyzing earnings statements and financial statements and ratios and all this stuff. It's a ton of work, and I got mixed results on that. I'd win some, I'd lose some. I didn't understand risk control, so I did have some big losers. You get some winners, and then you give it all back, plus some. Maybe some of you have been there, and that's no fun. I got frustrated, totally gave up on the market for a while. In 2007, I was just lucky, blind luck. Got out before the market crashed. Just went to cash, and then afterwards, I got back, and I was like, I just couldn't stay away. Right, this is too cool. I really enjoy trading. I got back in 2009. Got into some trades like Bank of America. I got Bank of America at $7. It goes up to $12, and I'm stressed out because I don't know what to do. How do I manage this? And that's, even a winning trade can be stressful. Maybe you've experienced that because, you're in a winner. You don't want to get out if there's more profit. You don't want to leave it on the table. But you don't want to give it back, right? So I got interested in technical trading about 2010, made a lot of mistakes, looked for that one indicator, that one magic thing that's going to flash green and guarantee a good trade. It doesn't exist. 2012, year-ish, I finally settled on my current trading system, and I started getting consistent profits, and risk control was really the key to that. And then in 2015, I launched this company, Follow Me Trades. I do mentoring, I have some training, and I publish stock picks to my subscribers. And I'll turn my camera on just briefly here. So there's a real person back here talking. I don't want to leave that on and be a distraction during the presentation, but hey, good morning, welcome. And I'm Dean Jenkins, and I'm glad you are here. Thanks. Turn that off. All right. So I said I publish picks to customers. It's the trades I'm trading in my own account with my own money. And you can see here's what I've done over the years. So fairly consistent. Averaging call it 25% per year. We're on track this year to have about 25 to 30% year, and so clocking right along, and typically beating the averages. Even when they're losing, we're making money, because you can make money in an up market or a down market. That's a good thing. All right. So again, feel free to ask questions as we go. Absolutely, happy to answer them. I'm going to explain my trading system. I'm going to walk through how I analyze a chart. I'm going to show you some trade candidates, some stuff I like right now that I'm getting ready to take if they continue to look good after the open next week. I'll look at some stocks you're interested in. Who knows? I might get a good idea from you if it meets my criteria. I often get good trades from people who go, "Hey, what do you think about XX?" Right? I'll extend an offer to you at the end if you want to follow along with my trades on an ongoing basis. So stay with me if you want to get the most out of this. And I love quotes from smart, successful people, about success. The secret to success is to be ready for your opportunity when it comes. Benjamin Disraeli. I like that. Right. And that's, for me, that, in trading, that means having a trading plan that you've already thought through and tested, and you're ready. So when you sit down at your computer and your trading platform, you start looking, you know what you're looking for, and then you have a strategy already devised, right, to operate on. And then Louis Pasteur, in the field of observation, chance favors the prepared mind. Same idea. We need to have a trading plan. We need to have some structure and some discipline. And then when we sit down, we can observe something that we were looking for in the market, right? Quick note about trading versus investing. They're different. They're different approaches. Investing is typically buy and hold long-term. It includes fundamental analysis of the companies. You got diversification, asset allocation, and may incorporate, I like a stock to hold long-term because it's got a high yield, right? Something like that. That's different than trading. Trading is typically shorter term. We're looking for short-term market swings. It's based primarily on technical analysis, can be backed up by some fundamental analysis, and we can profit from moves up or down in the market. And even, if I think it's a great company in the short term, there may be an opportunity to go short because it's pulling back, in the short term. Or a lousy company could be going up. Think about GameStop. Now, GameStop's interesting. Everybody was thinking about that a few weeks ago. That was really more gambling than trading, and I didn't participate in that. It was, very much an emotion and whipsaw kind of thing, and that's not what I'm trying to do here. All right. Here's what I've learned over the years, what it takes to be a successful trader, right? And I said, here's my secrets, right? And there really are no secrets. It's basic, right? To be a consistently profitable trader, you need a plan. Right. And these three elements of your plan are essential. You got to have trade setups that you're looking for, right? There's a specific set of technical indicators and conditions that give you an edge, right? A high probability outcome. You got to have great reward to risk ratio in your trades, meaning if it wins and you're correct in your analysis, you're going to make more money than it will lose if it fails and you're wrong. Right? And that's called reward to risk ratio. I'll show you that on a chart. You got to have risk management. You got to control how much a trade would lose if it did lose. Any trade, no matter how good the setup looks, right, how great the company is or how terrible the company is, right, you go, this just has to happen, right? All my indicators are lining up perfectly. My setups are perfect. Any trade can lose. And so given that reality, we have to figure out how much money am I willing to lose if this trade does fail, and have that be an acceptable pain-free amount. I got a formula and a method for that. I'll try to tell you. You got to then have trade management. So once you're in the trade, you have to have a predetermined script to manage it so that emotion doesn't take over and you make bad decisions and, you know, leave money on the table and all that kind of stuff. So those are some key things that I've learned, right? I use some tools in my analysis. I try to keep it simple. I use Dow theory, which is a, you know, trend analysis. It's a portion of Dow theory for a trend analysis, looking for a proven trend and then proof of when the trend is ending. I use Ichimoku Cloud. I'm looking, you know, it helps confirm that a trend has begun. It provides support and resistance areas. And I use Elliott Wave, very simple, repeatable version of Elliott Wave. I'm trying to identify either an impulsive move or a corrective move. You can treat them both. And again, the overriding criteria, I got to have a high probability outcome, right? I got to have an edge. That there's a, you know, better than even chance on the thing going my way. And I got to have a good reward to risk ratio. So Lucia is asking a question. Let me read it here. So he's saying, hey, he's taking small trades, $100 here and there, but obsessed with Tesla and Neo. Got in late, now he's losing. He wants to know any idea if they're going to go back. We'll take a look at those charts, Lucia, here. I know a lot of traders seem to focus, I won't say obsess, focus on a handful of stocks. And, you know, they're the marquee stocks that you hear about in the news, right? Or maybe, you know, they're in the news or they're companies, you know, or, you know, Tesla, wow, you know, it's exciting. Or Neo, it's the new Tesla. I like to look at a broader group of symbols. So I'm looking for a particular pattern, right? And that pattern may not be there. If I look at Apple, if I look at Tesla, if I look at Microsoft, I just may not have an advantage on that particular chart. So I want to look at a wider universe of symbols where I can find the pattern I'm looking for and have probability on my side. And for me, it's exciting to go, you know, do some scans, use some tools, and uncover a great stock chart. It's something I've never heard of. I'll do a quick research. Who are these people? What do they make? What sector are they in? Any problems? You know, any big news coming up? But then it's fun if you can find this needle in a haystack, some unknown company, and knock out a big win on it. That's satisfying. So yeah, we'll get to that. We'll look at it on the chart here. All right. So those are the tools I look for. I'll show you on a chart. So here's a quick view of Dow theory. Charles Dow, late 1890s, he was the founder of the Wall Street Journal and the Dow Jones Corporation. And he wrote a series of editorials in the Wall Street Journal in the 1890s, talking about what he had observed and some theories he had created for how the market moves. So one portion of that, and it's still valid, right? Over 100 years ago, it's still valid stuff, right? One thing he said was, hey, an uptrend, the definition of an uptrend is a series of higher highs, higher lows, higher highs, higher lows, right? And as long as that pattern continues, it's still in an uptrend. A downtrend is lower lows, lower highs, lower lows, lower highs, so on until it ends. Well, that's really helpful, right? It looks so simple, but until you have it pointed out, because you get, you know, you go long, it goes up, it never goes straight up, right? And then it pulls back, and you, you know, is the trend over? Should I get out? And it goes up, right? As long as it stays above these, what are these support levels, these pivots, right? This is a normal price movement in an uptrend, right? So I use this to place my stop. So if I get into if I were to, you know, take this trade here, I'd start with my stop at the beginning and then move it to the new support level and move it here. And what that means is when that trend ends, I'll know and I'll close the trade. I'm not going to be able to call the top, but I can get out when the trend ends. In the same way going down, right? Put my stop here and then here, just trail it like this, right? And that's trailing it to new resistance levels or new support levels, not using the trailing stop feature in a platform where you just fix it at some dollar or percent amount. So I trail my stop according to price action using Dow theory. And I confirm that a trend has begun. It takes 3 data points to confirm a trend. We got a high, higher, low, new high. That's confirmation that a trend is beginning. When is it over? Low, lower high, new low. Downtrend, low, lower high, new low. Downtrend begins. You know, doesn't put in a new low, goes above the previous high. Bearish trend, and downtrend is over. So it's pretty helpful, right, to have a definition and you know, have this explained. So as we look at charts and we're in trades, we can make good decisions, objective decisions. Ichimoku Cloud, you can see the shaded region here. These lines are part of the Ichimoku Cloud indicator, and it does really good you know, when price breaks above the cloud and the cloud changes color from, like this case, red to green, that's a real strong indication that a new trend is forming. And we combine that with Dow theory: high, higher, low, new high, and it's breaking above the cloud. Now we have two separate theories or studies confirming the beginning of a trend. And then Ichimoku cloud can also predict and display support areas in a trend. So you can see this one broke above. We got a nice strong uptrend going. Yeah, there's higher highs, higher lows, higher highs, right? But it's showing, hey, as long as this cloud is really thick, right, there's a really good chance that this trend is going to continue, and it'll be a support area for these higher lows. And then as the cloud thins out, there's a higher probability that price isn't going to break through it and the trend's going to end. So that's a helpful deal. And then Elliott Wave, I know you've probably heard or seen some really complex approaches to Elliott Wave. I look at those and my eyes roll back in my head. And I couldn't do any of the stuff that I see in these super complex markups on charts. And I think it's going beyond what Ralph Nelson Elliott talked about when he first produced this theory back in the 1930s. Interesting, he was working on this theory at the same time that Japanese journalist Goichi Hisada was working on Ichimoku cloud in Japan. They both were doing their thing in the 30s, doing their research, and it's still good stuff today. So this is the idealized pattern for Elliott Wave, right? You know, wave 1, 2, it's the beginning of the trend. 3 is the biggest move. It's impulsive. There's typically a correction after a big move, and then there's a follow through with another impulsive move, and then there's a complex correction after it. I'm only trying to trade wave 3, 4, and 5, right? 3 is typically the biggest move, but you know, you can get head fakes. Sometimes it looks like it's starting and it doesn't. 4 is a corrective move. You can trade it. Corrections are a little tricky. 5 is the best. That's the one I really like the most, because you got all this history and this pattern where a particular chart is conforming to Elliott Wave. And that's an important point. And I said, you know, earlier that, you know, I don't fixate on individual, you know, just a handful of stocks. Well, I'm just going to look at Tesla and Amazon and Apple, because, you know, it may be months before they fall into a, you know, kind of a predictable pattern where there's a good trade setup for me. And I don't want to wait. I want to go find charts that are doing it now. So I look at a pretty broad universe of charts and I scan. You know, I'm going to make sure there's good liquidity and, you know, several other things, that it's a legitimate thing to trade, good volume, good option market, right? I don't trade penny stocks or low float, you know, thin stuff. That's not good. Let me show you a chart that conforms, right, to this pattern that I'm talking about, a good Elliott Wave presentation. I'm interested in Qualcomm right now. So Qualcomm, you know, semiconductors got kind of beat down earlier this year. Last year, you know, so here's this wave 3. This is a beautiful, orderly move. This is very clear, right? This is a big move, right? From $60 to $160. I'd call that big. There was a correction, and this trend, this uptrend, temporarily ended with a low, lower high, new lows, right? Low, lower high, lower high. Came down to the 200-day moving average, found support. Now, high, higher, low, new high. This looks like the uptrend is beginning. Now, this wave 4 correction, I can check using Fibonacci retracements whether that wave 4 retracement was really, you know, good enough and where we expect it to go, and it was perfect. We expect a wave 4 correction to retrace into this Fibonacci retracement zone between 38.2 and 61.8. Perfect, right into it, and right at the 200-day moving average, which is this white line. Now, where's wave 5 going to go? Well, there's a good probability based on this history, right? The way this thing's conforming to this Elliott wave pattern, there's a good probability that we're going to use Fibonacci extensions, right? And so the target for this extension for the next impulsive wave, right, which would look like this, right? This one's conforming pretty well, right? There was 4, we're looking for 5. Where's 5 going to go? Well, the Fibonacci extension says up into here, right? Up to 188 to 228. Now it won't go straight, right? But it'll work its way up here in a series of higher highs, higher lows. This is a probability. This is no certainty, right? but this is highly probable. So this is the kind of trade setup I like. And Lucia's saying everything is so volatile nowadays. Does this still apply? Well, what we do is look for charts that are not volatile, right? This Qualcomm chart's very orderly. So, you know, some of the craziness that's going on with some symbols isn't applying to this one. You know, I've been doing trading and investing for 25 years. There's always, you know, some big deal coming and something everybody's worried about, right? It's never clear sailing, right? the saying is the market climbs a wall of worry, right? And at some point there'll be a correction to the overall market. Don't know when that'll be. Looks like I showed earlier that we're losing some momentum in the uptrend on the indexes, but for now it's heading up, making new highs. So yes, short answer is absolutely still applies. Okay, so that's the kind of setup I'm looking for, and this one's ready to go. So Monday, if it's still, you know, if it hasn't crashed, I'll probably be taking that trade, and I'll take it with a long call option. I got a whole method for picking the option contract that I like, but this is what I'm looking for. And you know, let's look at my favorite poster child. I worked for Intel for a long time, great company, really enjoyed it, learned a lot. But this is this is Intel chart, right? This is a chaotic chart. I wouldn't try to use Elliott Wave on this. Look at the way this thing gaps. Bam, bam, bam. You can't predict those things. There's no order to this one. So in terms of, you know, volatile, you know, erratic chart that we have no probability on, this would be, again, the poster child for it. And I wouldn't try to trade this. You could day trade it, but in terms of trying to swing trade and hold a position for, you know, a couple weeks, I like Qualcomm a lot better. If you just, you know, look at that and then you look at, you know, how this one's got gaps, but they're not nearly as big. And the overall presentation here is big. And these gaps weren't earnings, and I don't hold through earnings. You can see really predictable, right? Every quarter, gap, 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 up, up, down. I don't hold through earnings because that absolutely can happen. All right, so that's what I'm looking for. Just applying what we saw on the chart here on the slide here to the real chart. Okay, risk management. You gotta, like I said earlier, you have to accept that every trade can lose. And so if that's true, then you have to determine how much you're willing to lose on a given trade, right? And make that a pain-free number. And so I have a formula for that, right? And you know, I use 2%, right? I use 2% as, you know, how much of my trading account am I willing to lose on any given trade? And the maximum for that is 2%. Sometimes it's less. I'll dial it back during times of higher volatility. But there's a risk of, there are what's called the risk of ruin tables, some statistics behind that. And as long as your win ratio is acceptable and your payout ratio is acceptable, 2% is a really good number, right? If you're losing 2% on losing trades, but you got a win ratio of 60% and a payout ratio of 2 to 1, you're going to be a profitable trader. How cool is that, right? So, you know, the simple arithmetic, you know, I go figure out where my stop is on a chart before I take the trade based on price action Dow theory. And then, you know, the entry is current price, and I just calculate, you know, what's the risk per share before I get into the trade. And then I determine, you know, I divide the risk per share into the risk amount. Let's do that on this, just make this real on this Qualcomm chart, okay? So here's how I, you know, start approaching. I go, okay, we got a high, higher low. This is where I want my stop. So I'll just draw a horizontal line here. Let's make it red so it's really clear, okay? Now I would go get the exact value of that price bar, but I don't want to bore you. Let's just make this quick. Red line, that's my stop. Why is there my stop there? Because if price pulls down to there, right, that means that this uptrend has failed. So that's the point I want to exit. You know, let's say I'm taking this trade right now. We take it at the current price. I'll just make that a light blue line. Boom. And then what's my target? Wow, I'll be conservative. I'll just put my target up in the lower end of the target zone. An important note on the target I'm not going to exit just because it hits the target. I really want to have a legitimate target based on some kind of analysis so I can determine the reward to risk for the trade. The risk is the distance from my entry to the stop. The reward is the distance from my entry to the target. You can see here it's probably 4 to 1. That's great. I don't want to, if my target was here and the reward was less, well, that's not a good situation. I could lose more than I could win. And if I take too many trades like that, I better have a super high win ratio to make that work. Right? Puts a lot of pressure on you as a trader. So here's this formula in action. Let me, hello Excel, kind of a math geek. So here's that formula I showed you on the slide. Here it is in action. So let's say we took this trade at current price, 137.79. Current stop is 124.35. Target is 189.42. Okay, so the suggestion here is using a 2% risk with a $50,000 account says, well, if we just do that pure math, we could go buy 74 shares, and that would be $10,000, and that's 20% of a $50,000 account. That's kind of a big position. So what I do is constrain it. I'll never put more than 15% of the account into any given trade. So let's constrain it. Okay, that's 54 shares, 7,400 bucks, right? If it hits the stop, I'm going to lose 725 bucks, right? 1% of, or 2% of 50,000 is 1,000. So that's well under 1,000. And my reward to risk ratio is 3.84 to 1, right? Call that 4 to 1. So if this trade wins, I'm going to make $2,800. And if it fails, I'm going to lose 725. That's a good situation. Okay. What's the light blue line? That's the current price. So if I were to enter this trade now, I just want to mark, I want to come back and look at this chart, after I get in the trade and go, okay, where did I get in? Where's my stop? Where's my target? Okay. So that's what those lines are. Just simple horizontal lines that I've colored. Okay. So that's how I approach marking up a chart. I like this trade. Again, I may take it on Monday. Let me show you something else that if you're into math or statistics for trading at all, you might find it cool. This is called a Monte Carlo simulation. I put this spreadsheet together to demonstrate this idea of reward to risk and win ratio and payout ratio, right? Win ratio, everybody understands that. It's, how many trades do you win versus lose? You take 10 trades, you win 6, you got a 60% win ratio, right? Simple arithmetic. Payout ratio is the ratio of your average winner to your average loser, right? So if you take 10 trades and the average winner is 2,000 and the average loser is 1,000, you got a payout ratio of 2 to 1. That's a more powerful statistic than your win ratio. It's more important. Let's demonstrate it. So this is a Monte Carlo simulation. What I do every time I hit save, it's going to go, you can see these numbers change. It's going to go simulate 50 trades down here in these tables for 50 trades. And what I've done is put in a win ratio and then an implied payout ratio by the max win, max loss. And so I put these numbers in, and like this is set at 60%. So it samples 50 trades with a 60% chance of winning, and then uses random number generator in Excel. And then there's a random profit or loss, right? Because if the max loss is 1,000, the max win is 1,000. Not every trade's going to hit the max, right? So there's some variability programmed in so that the max it will lose is 1,000, but it could be smaller. The max it would win is 1,000, but it could be smaller. And then this chart showing the distribution of different win sizes, lose sizes. So hope that made sense. So if I sample it here, I got a payout ratio of 1 to 1 and a win ratio of, let's make it 65, right? 65% win ratio, but it's a 1 to 1 payout ratio. You take 50 trades, right? $50,000 account, 2% risk. Took 50 trades, you made 7,300. That's not bad. I'm going to cycle this. Watch this cell right here, and you can see across 50 trades, what's the P&L? Well, that was a good one, and that was okay. And that was a good one, and that was okay. Look at the swing, the variability in that. And if I cycle this enough times, even at a 65% win ratio, every now and then you're going to take 50 trades and end up with a net loss because the payout ratio is terrible. Okay. if you have and a 2-to-1 payout ratio, right, and a 65% win ratio, and by the way, it you go, yeah, Dean, you could just change a number on a spreadsheet. Well, I can do more than that, right? I can only take trades that have a high reward to risk ratio, that have a potential to make more if they win than they lose. So I can control this by the trades I take and then how I manage them, right? So it's not just plugging a number in on a spreadsheet. I get to choose what I trade, and I can choose to only take setups that fall into this criteria. And now keep watching the P&L cell here, right? This is much better. There's still some variability, but look at, these are much bigger numbers. And what will never, ever happen with these statistics, will never go red. Can't. We've got math on our side. As long as we make sure we stay within those parameters, right? How cool is that? Right? Now, we can go choose trades that have good setups like this, but we can then undermine the system by jumping out early, because there's a real desire, right? Say I go take this on Monday morning, it pops up to 150, and you know, I make 500 bucks. That's awesome. I just want to get out. I don't want to give that away. I got to win. I'm just going to take the win, close trade. What happens if I do that? It's totally undermined my system, right? And now if I got small winners and bigger losers, because I'm not, you know, human nature, we're going to let it go to the stop, right? It's terrible, right? Even though it felt good to take a win early, right? It just totally undermines my trading system, and it produces terrible results. So, power math, right? Just keeping it simple, keeping it objective. What do you think of that? All right, risk management. Let's all right, you got to have great trade management as well. You take profit at the right times. I do scale out. So on a chart like this, right? Like if I get into Qualcomm and this thing starts moving up, like I said, I'm gonna, you know, if this goes high, higher, low, high, higher, low, right? I'm gonna start with my stop here, and then I'm gonna move it to here, and you know, so this is part of trade management. Trailing I stop to new support levels, and then you know, as it crosses key areas of a Fibonacci line, or you know, goes through a gap or something, I'll take a third off. Take 1/3 of the position off, lock down some profit, but let the rest run. And then, you know, I'll take another third, and then I'll let the final third run until it finally stops out. So that creates some balance between locking in profit, reducing risk, but looking for the, you know, the win to be as big as it possibly can, and stay with the trend. So that's trade management. All right. Yeah, it's just a slide showing what I just told you. Showed you on a live chart. All right. So overriding concepts, the secret is keeping it simple, controlling risk, and being objective, right? And so I've already shown some charts. So if you've got a symbol you would like to look at, go ahead, type it into the chat box. And Lucia did earlier, he wants to look at Tesla and NIO. Let's look at Tesla. Tesla is as much a religion as it is a car company, in my opinion. So Tesla had a big impulsive move up. Clearly that's wave 3. It had a wave 4, right into this Fibonacci retracement zone. And now what's happening? High, higher, low. It has not put in a new high yet. So I would watch. And if it gets above this high, which is at 722.99-ish, right? If we put in a high here, there could be a case to be made that Tesla is now in wave 5 and could be heading up to these extension areas up here. This case is not proven yet. We got a high and a higher low. We do not have that third data point that would confirm it. And I also like to see this momentum indicator turn green, and I like to see the price get above the Ichimoku cloud. So it's early. So I would just keep watching that in terms of trying to go long on Tesla. All right, NIO, the Chinese Tesla, right? It's the same chart. It is exactly the same chart And the level to be watching for to confirm the uptrend is at about 46.70. And you could say, well, if I think it's going up, why don't I take it here? It's a better entry. Right now, the probability is low because this thing could also, it has not proven that it's in an uptrend. You got a high, you got a higher low, but it could sit here and channel like this for months. And it might, right? So the probability right now, but if we get this, Dow theory tells us that's a trend, right? That's the beginning of a trend. So if this happens, if this goes positive, if we get above the cloud, those things would all point to, okay, we got an uptrend. And we don't need to worry about jumping it and getting an entry here because, right, if we're right, there's plenty of room, right? This thing's going up to between 69 and 93 up into this zone, right? I'm willing to trade a few points of entry for probability. How's that? All right, G, Young, Marvel, ADI, NVIDIA. So you're focused on silicon. I told you I liked Qualcomm. I think ADI is very close, but let's look at Marvel. All right. So Marvel looks very similar to, here's the semiconductor ETF. It's got 20 or 30 of them. This is SMH. A lot of the individuals look just like this, and this just broke out, right? This one, you know how we said Tesla and NIO hadn't done this yet? High, higher, low, new high. This is a good long, right? If you want to trade the whole sector, SMH isn't a bad idea. Marvel, it's there, high, higher, low, new high. That looks good. I think that looks good for a long entry right now. ADI. Same thing. I wouldn't trade them all together, right? If you go use the 2% risk that I discussed, right? And you take all three of these, or if you like Marvel, if you like Qualcomm, there's the same trade. These are all the exact same chart. They're all the same trade. I would not take them 4 or 5 individuals, right, at 2% risk, because they're either all going to win or they're all going to lose. They're the same chart, right? If you want to play them all, smooth it out, do the ETF. The most I'll take that are in a close sector like this is two of the same trade at one time. Okay. Ride. Yeah, so look at this. So I said, not every chart's going to conform to an Elliott Wave pattern. Here's another case study, right? This is a chaotic, right? Huge moves and nearly 100% retracement. I told you I'm looking for a Fibonacci retracement into this blue zone, right? This went way too deep. In fact, it went through a disqualifying level of 76.4. So this move is not a correction to this move. This is a new trend. And then there was another trend. And then there's, it's just a roller coaster, right? Now, you could, in the short term, trade this thing and go, well, look at this support level, right? Here's where the whole thing started, and it's coming off that bottom, and you could look for a high, higher, low, new high, and see if you can catch, the next one. It's a little bit riskier trade, and so I'm not excited about it. The volume here is good, 8 million shares on Friday, so it seems like it's reasonably liquid, but it's a bit of a wild ride. So not so much, not really my thing. I like the more orderly ones, higher probability. Okay. Where are we at? Okay. So finding great trade candidates, it can be like a needle in a haystack, because the ones you like, the Microsoft, the Apple, the NVIDIAs, whatever, they may not have a good setup at the moment, right? And you got to go scan the whole market and find great trade setups. And that can be like a needle in a haystack. But I showed you some good ones. We saw a couple that I liked. I'll show you. Everything we talked about so far has been long. I'll show you a short setup that I like right now. Because just because the market's going up doesn't mean everything's going up, right? Here's DVA, DaVita, right? Had a nice move up, it's clearly in a downtrend, right? Low, lower, high, low, lower, high, low, lower, high. It's going lower, right? And we got a zone down here, a retracement zone that we expect it to make it into, and a really big support area there, right? So we're looking for it to do this, right? We put a stop here, enter here, put a target in the middle. That's a 2-to-1 reward to risk ratio. So that is a nice looking short setup for me. Another short one is Urban Outfitters. Same setup, low, lower, high, looking for a new low. If it does it, we got a nice target down here. Not quite ready yet. All right. So finding great trade candidates can be like a needle in a haystack. Remember these essential things, right? We got to have good trade setups, high probability outcome, reward the risk, manage the trade, right? Do you guys believe that you know, the secrets to trading aren't really a secret? It's all about keeping it simple. You guys, you know, does that make sense to you guys? Just type in a yes, a Y, click the hands up button there on the platform if you agree with that. Here we go. Lucia agrees. A couple others. Can be good. Thank you. All right. I mean, it's hard to disagree with, right? How many of you excited about some of the trades we just looked at? I showed you Qualcomm. The other silicon stocks look pretty good. I like CRISPR. AMD actually looks good. And these shorts on DVA and on Urban. You guys are kind of interested in those trades? Look good? But maybe you're a little bit unsure how to act on it. Should I trade shares? Should I trade options? What contract? Where would the stop be? Maybe you feel like this guy. It's like, wow, that was a lot of information. And he went through it pretty fast. That was like drinking from a fire hose. Well, I'd like to spend a few minutes going over a special offer I have related to what we just talked about, a way you can follow along with me, right? Finding great trades is hard. Once you find them, you need a plan, right? Then you need to manage the trades. I've been getting good results year after year, averaging between 25 and 30% per year. You know, those are real numbers. They're audited numbers. I have a third-party CPA firm audit the results that I post on my website, right? You know, what's something like that worth? You know, on a $50,000 account, the average payout here has, you know, been about $1,900. You know, as part of my service, I provide about 10 hours a month of detailed trade consultation and live interaction in a trading room and in live chat sessions where we continue to teach and answer questions and analyze your trade ideas. You get a one-on-one consultation with me when you sign up, and you get ongoing education. I provide tools and training for options, risk management. I have calculators and stuff to help you interpret all that stuff, right? If you know, it'd be thousands if you were to go buy that stuff individually from me or anybody else providing these kind of, you know, services, right? So I'm going to offer you all of that. Great trade setups, risk management, trade management, the, you know, the ongoing interaction in a trading room and in live chats, one-on-one consultation, education tools. I'm going to help you with all that stuff. Access to winning trades I'm taking and publishing. It's not going to cost you thousands. My list price on my website is $127 a month. It's a good value there. That's $1,500 a year. In this webinar, I'll offer you a 30-day trial for $37. And then if, you know, you get through the trial, it's like, yeah, I want to stay. It's $97 a month after that. That's a pretty good discount and a pretty fair price. And that I'm putting a link in the chat box here for you if you want to hit that. And there's 100% money back guarantee. You know, I've got, you know, I've been doing this 6 years. I got some customers who've been following me the whole time. Got some folks who are new. Most people who give it a shot are happy. They like it. They stay. You know, some it's not the right thing. It's not a good fit. 100% money back guarantee. If it's not a good fit for you, no hard feelings, no questions asked. I'll give you a refund, man. And we'll you know, it's all good. It's all good. Doesn't matter what platform you're using. You know, if you want to follow my trades, I want to send out alerts, and I'll explain how that works. You can, as long as you have a funded brokerage account with somebody, you can go act on the trades. If you want to learn my trading system, I have some mentoring, some training programs. You're going to need a high quality charting program like Thinkorswim or TradeStation. Okay. All right. But you can act on my trade alerts with any brokerage account. All right, what do you get? You get a watch list of potential trades I found, just like I'm showing you today. We go over those in the trading room every morning. You don't have to attend, it'll be here. You get alerts, right? You get an email, and I have an app, a dedicated app, iPhone and Android. So when I send out an alert, it pops up on your phone and got all the details you need. You get the exact details of the trade, entry, the stop, to target. Most of the trades can be either traded with shares or with option contract. It's your choice. I send out, here's the share information and here's the option contract that I like for the trade. You get alerts when, the same way email and an app alert when I'm going to make a change, move the stop, take profit, or close the trade. You get access to my live trading room. It's Monday through Thursday, half hour after the market open. We're there for half an hour, looking at the watch list, looking at the trades, answering questions, doing training, and looking at any trades you're interested in. It's not mandatory to attend. You're going to get the alerts. You sign up for the service, you're going to get the alerts, whether you come to the trading room or not. Some folks just like to come, get some information, and participate. You get a weekly live chat session. If you day job, you can't make the morning sessions, we do an evening session midweek. You get one-on-one consultation. You get the risk management, option trading tools and training, and ongoing support. And then, but wait, there's more, right? I said I use Ichimoku Cloud. I have a course that teaches how I use Ichimoku Cloud and some unique settings. And that course on my website is $247. If you sign up today, during this webinar, I'll include that course in that 30-day trial for just $37. So you can take the trial, see if it's a good fit, and get this course. So trying to just sweeten the pot there a little bit. All right. So again, 30 days, $37. It's $97 a month after the trial, and you get the Ichimoku Cloud course. The link is here on the screen, and it's in the chat box. So any questions before we go ahead and wrap things up? I know it's Saturday morning. I sure appreciate your time, your willingness to be here, and I hope you found this valuable. I hope you found it useful. Whether you signed up or not, I hope you learned something, picked up a couple gems that may help you in your trading. All right, well, hey, thank you again. I'm gonna go ahead and stop the recording now. I'll hang out for a few minutes and see if any other questions come up. But hey, have a great rest of your day, great weekend. Have a happy Easter if you celebrate it. We'll catch you next time.